Hello and welcome to this week's special presentation. My name is Jim Penna, Manager of Retirement Services here at VectorVest, and I'm very happy to be your host for this week's topic, which is titled Secret Number 5, Learn to Trade Options. Our founder, Dr. Bart DiLiddo, has presented the 7 secrets to making money with VectorVest many times over the years, and I know I learn something new every time I hear him lay out those secrets. Tonight, I'm going to focus on secret number 5, Learn to Trade Options. Now, if you'd like to see the entire presentation of the 7 secrets, Ms. Kathy Onen, my friend and colleague, gave a great presentation on January the 13th, 2017. You can go into the Views tab from the VectorVest homepage to view that special presentation. Now, secret number 5 focuses on why you should learn to trade options. So my goal in this presentation is not to turn you into an options expert in one sitting, but rather to convey the important advantages of understanding just a few basic option strategies, and I'll do that with some helpful illustrations here. First, the question, why learn how to trade options? Now, we know trading is filled with a lot of what ifs. So what if you could increase your leverage without paying extra margin rates? What if you could profit from falling prices with limited risk? What if you could insure your positions or even your entire portfolio? And then finally, what if you could generate more income in your account? Well, the versatility of options can turn these what-ifs into reality. You can do all the above using the power of options. So let's start by comparing some of the characteristics between options and stocks. First, how are they similar? Well, an option contract is a security, and it trades just like a stock. It has a bid-ask price, and there are market makers who are tasked with providing a fair and orderly market, just like an underlying stock. Where they differ, first of all, is that there is less capital needed for option trading. Options generally cost a small percentage of the underlying stock, and the example I'm going to use throughout this presentation is Shopify. On 6/21/2019, the stock was trading at $329.47. So let's start by taking a look at an option chain here, and if we look at what would be an at-the-money call option at $330 strike price, we're out 56 days to an August expiration. The cost of the stock, again, we'll call it $330 per share to own the stock, where the last price on the call option was only $26.30 per share. And we'll dig deeper into that in a moment. So there's less capital needed to trade options versus stocks. And that leads to lower risk, because options control a given number of shares of stock with substantially less investment exposure. Now, just a quick side note, that does go for long positions only, if you're long a call or a put. So here's an illustration of the same numbers. On 6/21, again, Shopify would have cost to go out and buy 100 shares, $32,947. That's where the stock was trading. The cost basis for just one contract, or the control of 100 shares, which is what one contract equals, would have cost just $2,630 to control that same amount of shares. So your risk is lower because your capital outlay is lower, which leads to more leverage, which is really the power behind options. So an example is a 5-point increase in an $80 stock would give you a 6.25% gain, whereas a 5-point increase in an $8 call option gives you a 62.5% gain. Let's take a closer look. Again, I'm using Shopify as our example throughout the presentation. If we were to have gone back to January the 18th of this year, the VectorVest program signaled a confirmed upcall in the market. So I'm going to use that as that indicator that it was time to be bullish, and we're going to use a call option as our example here. Had we gone out and purchased 100 shares of Shopify on that date, it would have cost $15,843. We look ahead 3 months to April 18th, and the value of that same 100 shares would have been $22,000 and would have netted us a $6,229 profit just 90 days later, which is a gain of 39%, which is wonderful. Again, the power of VectorVest, finding the right stocks at the right time, would have netted you a 39% gain. But let's take a look at the power of leverage. Had we gone out and purchased one contract back on January the 18th, that option was trading at $17.20 per share. So for one contract, it would have cost $1,720. The value at expiration date, just 90 days later, would have been $6,502 and a net profit of over $4,700. Now that translates to a 278% return on your investment. I was part of a webinar just a couple of days ago, and we were showing some examples, and someone typed in the box, well, what do I care about the percentage gain when I was making more money with the 100 shares of stock versus the one contract? And other than the obvious advantage of having to expose less capital and the larger return on investment, the answer becomes much more clear when we go down to, say, 3 contracts. So instead of buying just one contract, had you purchased 3 contracts, it would have cost $5,000. That value at expiration would have been $19,000, and the net profit there would have been $14,346. And so here's where the leverage kicks in. For a third of the cost, you've more than doubled the net profit had you only owned the shares of the stock. And as we increase the number of contracts, we see the power of leverage when it comes to trading options. For those who may be new to options, let me start here with this table. We found this a great way to kind of break down the foundation of option trading. Understand there are just 2 types of options. There are call options and there are put options. There are buyers of those calls and puts, and there are sellers of calls and puts. When you're the buyer of an option, whether it's a call option or a put option, you pay money to enter into that contract, and by paying that money you receive rights. If you're the seller, you get paid. But just like life, you don't get paid for nothing, and so you take on obligations. Let's start with the buyer's rights. If you buy a call option, you are buying the right to buy units of 100 shares of a stock at a certain price by a certain date. Remember, it's an option contract with strictly defined terms and conditions. That's what an option contract is. Those terms and conditions are the certain price, which is the strike price, and the certain date, which is the expiration date. If you're the buyer of a put option, you have the right to sell units of 100 shares of stock at a certain price by a certain date. Now, the buyer of a call option, the box here is green because that is a bullish trade. You have a bullish bias on the market and an underlying stock if you're buying call options. And conversely, if you're buying a put option, you're buying the right to sell, which means you would have a bearish outlook on an underlying stock or the overall market. Now on the sell side, again, we take on obligations. So if I were to sell a call option, I would be obligated to provide those shares or sell those shares at a certain price by a certain date, which would imply that my bias on the underlying stock or the market was also bearish. And then finally, when it comes to puts, if I'm a seller of a put option, that would obligate me to buy shares of a stock at a certain price by a certain date. And so I better be bullish if I'm going to be obligated to buy the stock. So just a quick breakdown of the 2 types of options and the buy and sell side. We're going to focus on the buy side as we continue through the presentation. Now, as I said earlier, we're using Shopify. I just want to walk through the anatomy of how buying a call option on a quality stock in a rising market help you to profit. So let's begin here. As I said earlier, on January 18th, 2019, the VectorVest program signal had confirmed up, telling us that the overall trend of the market was up. Shopify was trading on that date at 158.43. It was a buy-rated stock with a very strong relative timing indicator, and so this is going to be my example as I walk through the trade. So with the stock trading 158.43 on that date, one trade to consider would have been going out to buy one April 155 strike call option, and it would have cost $17.20 or $1,720 for one contract. Now in that particular option, the April 155 call expires on 4/18 of 2019, at which point Shopify was trading at 220.72. So again, that's at expiration. Now in that time frame, Shopify stock moving up to that 220 level left us with a profit of $62.69 per share. Times 100 shares gave us that profit of $62.29, or that 39% return on investment we talked about earlier. Again, not too bad. However, the option profit again was $47.82 at expiration, with that call option trading at just over $65 per share and giving us that 278% return on investment. So that's an example of how you can profit in a rising market with a quality stock, especially a stock that's trading at higher prices where you can employ the power of leverage in your trading. Now, we also mentioned one of the advantages of learning how to trade options was the ability to protect or insure your portfolio or individual positions. So next I want to show an example of how you can profit in a downtrending market or use a put option as a way to insure or protect your portfolio in uncertain or downtrending markets. So I'm going to use the SPY, which is the ETF that tracks the S&P 500, also known as the SPDR. And let's set up our scenario here. I'll go back to the beginning of October of 2018, just as my illustration here. We received the confirmed down call on that date. Now we know what happened throughout the end of 2018, and so it would have been a great time to use the information in the VectorVest program telling us it was a strategic time to become defensive of our portfolio, or if your objective was to simply profit in a downtrending market, put options on the SPY is a great way to do it. So the SPY was trading at 289.44 at the close of trading on the 4th of October 2018. In our example, I'm going to go out to buy 1 December at the money put option, or the 290 strike price. That option would cost $6.42 per share, or $642 for the entire contract. Now, just to be clear on all of these examples, I'm going out to expiration to show the potential of the return on the trade. There are trading techniques and trade management that certainly may have had us out of this trade. We don't advocate holding all the way to expiration. But again, the idea is to illustrate the power of leverage and the power of using options to profit in both falling and rising markets. So keep that in mind as I walk through the illustrations here. Now, the SPDR put option expired on 12/21/2018. This was the date right here. So the market, again, after the signal of the downturn that VectorVest had showed, if you had gone out and protected your portfolio for any stretch of time here, you would have mitigated losses in a portfolio or profited through much of that stretch of that downturn from October to December in late 2018. So the 290 put expired on 12/21. SPY was then trading at $240.70, and the option was all the way up to $49.55. Remember, we only paid $6.42. That's at expiration. But for the illustration, that SPDR put option profit again is $43.13 per share for just one contract. That's a $4,300 return, or 671% return on that investment. If you have a $100,000 or $200,000 or $300,000 portfolio and you're nervous or uncertain about where the market's going, and especially if the VectorVest program is signaling a confirmed down call, that's a great time to go out and buy insurance or hedge your portfolio. And if you had bought 3 or 4 or even 5 contracts of the SPY under these conditions, you would have mitigated and maybe even profited during that mayhem that we saw in late 2018. And so if for no other reason, the ability to insure individual positions or an overall portfolio is more than enough reason to understand and learn how to trade options and heed secret number 5 of the 7 secrets of making money with VectorVest. The next thing we said you can do, the power of options and why you need to learn to trade options, is that you can generate income in your portfolio. I'm going to go back to Shopify and illustrate a covered call option, which is a great way, a great steady, safe way to generate a consistent income in your portfolio. We'll use the same scenario. The confirmed up call came on January the 18th. You could have gone out and purchased 100 shares of Shopify at $158.43 if you were looking to actually own the stock versus just trading the option. At that time, you could have simultaneously gone out and sold one Shopify February 165 strike call option, and you would have taken in $6.48 per share, or $648. What that does is lower our cost basis for the price of Shopify. Instead of $158.43, our break even, also the cost basis, is now $151.95 per share. So we've built in a cushion, we own the stock, and we got paid that $6.48. Now I went out to the February expiration here, because we're usually looking anywhere from 30 to 45 days when you're selling covered calls. keeping in mind the objective here. I don't care that the stock continued to go up after my expiration date, because my objective to placing this trade was to generate income. And I knew exactly what I could generate going into the trade, because what happened was Shopify closed at 178.19 on the February 15th expiration, which allowed us to earn our max profit on the trade. The max profit was $13.05. How do we arrive at that number? Well, we own the stock at 158.43, which means if the stock at expiration is above that 165 price, we get to keep the $6.57 capital appreciation from 158.43 to 165. We also get to keep the $6.48 that we received when we sold the call option, the covered call. We're covered because we own the stock. We're obligated to sell the stock if we are assigned, or if the buyer of a call option exercises their right. As the seller, we're obligated to sell. But that's okay because we own the stock, so we're covered. So the $6.48 premium plus the capital appreciation gives us a payday of $1,305 over a 28-day span. That's an 8.5% return. Again, an illustration of exactly how you can profit by using very simple option trades and generate that steady income by selling covered calls. So secret number 5, learning to trade options, is going to allow you to employ the power of leverage. It's going to allow you to profit in falling markets as well as rising markets. It's going to allow you to insure your portfolio and generate income. So I'm usually pretty good at keeping secrets, but this is one I had to share. Now, if you're interested in learning more about options, we do have our Options Jumpstarter course starting next week. Our Options Jumpstarter course is a digital course with 6 modules that begin by building a foundation to understand options. In Module 2, we set up our call options. We walk through the system for profiting in uptrending markets, showing you how to use the VectorVest program to prepare for those uptrends, how to set up your call option, knowing your rights. We do the same thing in Module 3 for the put options, how you set up your put options to profit in a downtrending market. It's good to know how to do that, but what's more important is being able to select the proper candidate. We'll show you in Module 4 how to pick the best candidate, how to filter out best underlying stock and the best option, because the best underlying stock is not always the best option candidate. We'll show you exactly how to do that in Module 4. Once that trade is placed, to be successful, you have to have a system of trade management in place. You have to be prepared to know what to do. We'll show you how to set your objectives and profit targets and how to exit that trade when those targets are met. And finally, we'll pull it all together by showing you the trade execution, how to actually enter your trades, how to exit them, and finally have an extensive trading checklist for you to follow to put all of the principles we talk about in place for you. You can sign up at www.vectorvest.com/jumpstart. We have 2 choices. There's a mastery package. The early bird special of $4.95 is good until Monday afternoon at 5 p.m. You get the full Options Jumpstarter course, 1-year access to the digital course. You'll get a bonus section, how to trade covered calls. If there are any non-subscribers listening, you will get 60 days of the VectorVest software if you're currently not a subscriber. And in the mastery package, we have an added bonus. We have 6 live mastery support sessions. Each week while the market's open, we'll walk through any questions you have from the modules. We'll look at different scenarios and situations, answer any and all questions about the previous module. We'll also have 2 bonus modules that will be taught live with a Q&A session as well. Again, that early bird special is $4.95. We also have a self-study package. You get all of those first 4 products for $2.95, but the live mastery and bonus modules come with the mastery package. If you have any questions at all, give product support a call and they'll be happy to help out.
Thank you for taking the time to watch this video. Now, if you're new to the software or would like refresher information about the software, click on this Getting Started video right here. Thanks to all of your input, here's a YouTube video that we think would be perfect for you. Click right here. If nothing else, folks, just hit the subscribe button right here.